All right, we are live with the Mortgage Geek in the house. Shiggy's here. What's up, man? What's up, brother?
What up, man?
How you doing? So
I'm doing good.
Doing the Shiggy, huh?
Yeah, ghost riding.
Now, people who know you know that you can dance. You know, my man can dance.
I like
But
dancing.
Just in case you didn't know, now this was posted on the Mortgage Geek page.
Yeah.
Which you have a brand new video that will be posted on the Mortgage Geek page later today, which we're going to premiere here in just a second.
I'm so super pumped about it.
But for your entertainment value, and I didn't know what the Shiggy was, to be honest with you, much less how to do it, and there's no way I could do this dance.
Kiki,
But
you love me.
But the geek can do it, and this is proof. Carrie, cut to the computer and feast your eyes on this.
Trap money, boom. Gotta be real with it. Yeah. Kiki, do you love me? Are you riding? Say you never ever leave from beside me. Cause I want you, and I need you. And I'm down for you always, KB. Do you love me? Are you riding? Say you never ever leave from beside me. Cause I want you, and I need you. And I'm down.
All right. Holy smokes. So that's incredible.
You guys, that was we only did one take.
I knew that. I knew it without even asking. I knew that was a one-taker. Now, when does Target make the phone call, though? Because they had the branding in the background the whole time. When do you get the call from Target and go, hey, listen, we kind of want to ride this thing out with you? Now, who does the song, the Shiggy?
Drake.
Drake, okay.
Yeah.
So Drake does the Shiggy song.
Well, it was Drake, and then a comedian did the original dance to that song, and then what happened was Chris Brooks and Blair. Blair does all my Mortgage Geek stuff, and she's a genius when it comes to production side, and being creative. So she was the one. They were like, "Hey, we got to do this. Like, this is perfect." So, and of course, I love dancing. I dance at the office. And so I was like, this is perfect. And then to actually pull off the ghost riding, like right before that, we were actually headed for a car. So like we didn't get to actually see that, but we had to hurry and jump in there and slam on the brakes. Yeah. So it was a true live ghost ride.
That could have made it go completely viral immediately if you had actually crashed the car.
We were talking about that, like, hey, what would happen?
What's the deductible, by the way?
Yeah, right. How are you going to tell your insurance company I was ghost riding and dancing the Shiggy when my car hit another car?
Is that covered? That's the question.
Yeah, I don't know.
So now that's just sort of off the wall, like in the heat of the moment kind of Mortgage Geek video.
Absolutely.
This is why you should like the Mortgage Geek on Facebook, because you have that kind of stuff, and then you have some stuff that's more put together, more produced, like the video we're about to premiere here for the first time, which will be posted later on the Mortgage Geek page, but you're going to see it right here for the first time. This is sort of you guys do sort of like parodies, and you do a lot of acting. You play all the characters.
Yes, always.
Including the Mortgage Geek, or if there's a female involved,
Fannie Mae.
you play the female. So you're playing all the characters in these things, but it's also it's educational. You're trying to teach people about things that are different about what's going on in the marketplace versus what you do with Cornerstone.
Yeah, so another thing, it was so awesome. So I always kind of like go through like YouTube recently. More and more I've been going back to YouTube and seeing like what other lenders. So like I did a recast video a long time ago, and then I saw like a couple other lenders coming out with a recast. Well, my recast was like talking about like recasting a poll and why it was different, and then theirs was just like a Facebook Live of recasts, or just like sitting there behind a desk with like a cell phone. So I'm trying to bring more excitement, but also like teach all the ins and outs of what's actually going on in the market, like what programs are available. Sometimes it's a little bit more informational than the other, because some of the programs are so detailed. It's like, no, just give me a call, right, and I'll explain them. But you know, these non-traditional and non-QM loans, like these are what's driving the market, and more and more and more of these loans are coming out. So it was like perfect time for this new video coming out.
Perfect time for this new video, which you're going to see right now for the first time. This will be on the Mortgage Geek page later today, but right now for the first time, the newest Mortgage Geek video. Carrie gets cut to the computer, and here it is. This is the Mortgage Geek versus Uncle Sam. This is Uncle Sam. And this is the Mortgage Geek. Uncle Sam is a bit more traditional, or as American white girls now call it,
basic.
And the Mortgage Geek? Well, he's a bit off the wall. Uncle Sam, aka the IRS, says,
I want your money in my pocket.
But he wants you to fit into a very specific box. Let's call it the qualifying mortgage box. The Mortgage Geek, he's a bit more flexible. To put it bluntly, he says,
Ha! That box!
Uncle Sam likes QM clients, or as we like to call them, vanilla clients. He loves them. These are your 20% down, W-2, full documentation clients. Again, basic as... The Mortgage Geek, on the other hand, prefers trickier situations. We're talking chocolate ice cream with caramel swirl and marshmallow swirl type of clients.
I like them all. You want some fish food, vanilla boy?
He's got a whole range of non-traditional, non-QM products to fit that stickier situation, like 1 month, 12-month, or 24-month bank statement programs and a 1-year tax return jumbo. So if you're not a basic vanilla client, or you just don't want to pay Uncle Sam, you should call the Mortgage Geek and hear about his non-QM products. And yes, there it is, the new Mortgage Geek video. That's all right. You did miss the very end of it, but we'll save that for, you have to check out the Facebook page. You got to like the Mortgage Geek on Facebook, and then you can see the entire video. There's a few more seconds of sort of bloopers and outtakes there that you can check out. That'll be posted a little later today. So, Mortgage Geek, while we have you here, there's a few things I always like to try to get from you because you're such a vat of knowledge when it comes to this stuff. First of all, programs. A lot of new, interesting programs, and we'll talk about some sort of market conditions that are changing and what people can do about those. So tell us about some of this non-QM stuff. First of all, what is QM, what is non-QM, and how does Cornerstone sort of separate from the pack with this stuff?
Well, you know, a bank statement program or like this, some of this non-traditional still can be classified as a QM loan. So QM loan is like a qualified mortgage, and then underneath that is like the ability to repay. And that's why, you know, kind of like the whole stated loan out there is kind of like pushed to the side because they really did figure out that if someone had like 300 grand in the bank, right, but we're just stating their income, they're more likely to foreclose even in a financial difficulty or a downturn of the market because they still want to preserve that cash. But the actual flip it over and look at like the doctor's program. The doctor's program is one of like the best performing assets, but actually on paper it's the riskiest. It's like 5% down using income that just started yesterday, no history of it. 5% down, I'm offering like a 4.5% on a 10-1 arm, no mortgage insurance, the payment's $6,000 a month, and that doctor will never, ever, ever miss that payment. Like the performing assets percentage is crazy on those really risky. And so what they realized is like, and nothing against doctors, but they're just known for spending everything they make. It's like recession proof, right? It's like you go to the hospital, you're always gonna make money, they get a certain amount of money, they crush it on the income, but they're just not always the best savers. That's just kind of, nothing against anyone, just I would say kind of hearsay. But so what they're doing is like, they're saying the ability to repay, so where's the income to qualify? Okay, well cool, well, we don't need to use 2 years of tax returns. Like 1 year of tax returns is plenty. Like let me see where the individual is going, because sometimes if we look too far into the past, we can never even get to the future. And so these more and more of these programs that are coming out are wonderful, and it's actually helping the community. It's helping the self-employed borrowers. It's helping with the wage earners that, you know, they spend a lot of money with their 401k or having a little bit of difficulty, you know, making sure they're under a 43% debt to income ratio so we can go up to 55 DTI. Because like somebody making $25,000 or $30,000 a month, are we really looking at a debt to income ratio? We should be looking at a residual income.
Yeah, disposable, yeah. Sure.
Right? So it's like someone making $25,000 after, you know, say they make net $25,000 and their bills are 10 grand, they still have $15,000 a month, even though in the eyes of our percentage, that's like, you know, 50%, compared to someone making $5,000 a month, at 50%. That's $2,500. What are you really going to do with $2,500? Like, that can actually put somebody into a tight spot.
It's been really interesting. I've always been confused why mortgages are qualified off of gross income and not net / residual or disposable income. It's so strange to me. But I think what you're saying, though, is that the qualified mortgage in the new programs that are coming out, whereas in the past, a lot of people are scared of it now because they think, oh, well, back in the day, these are the programs that sent us into the recession. Not true. Back then, they were looking to give money to anyone. Now, the creative financing is trying to find a way to get financing to people who they think can actually pay it back.
Absolutely. I mean, I have a borrower right now, and on their tax returns, you know, the last like year and a half, I mean, they're making decent money, but they're trying to buy, you know, in the millions, and they even have the down payment. So I was like, hey, why don't you send me over your 12-month personal bank statements? Let me see the actual commission checks that you are getting deposited into your account. And their income was $12,000 more than what was on the tax return. I get it. It's like, that person in my eyes is actually really safe. Yeah. That is a safe bet. They're putting down 20% on, you know, $1.2 million. It's $240,000. If you know anyone that's willing to walk from $240,000, like, I mean,
net money.
Yeah, like, please have them call me because I'll like loan it to me, right? And so it's like, that's a safe play. And I just don't understand why some of the banks are not going in that direction. I mean, thank you for not being like that big of a competition, but that's really kind of where I'm driving a lot of my jumbo paper. Because you guys, I can't compete with Chase and Bank of America and Wells Fargo with somebody that makes $300,000 and has $400,000 and they want to put down 30%. I mean, they want them as a depository. So it's like, the interest rates that they're being offered is almost like what our line is. So
they're giving it away, basically.
Yeah, they would give it away because they make money on the depository or the credit cards or the car loans in the future. So I don't want to compete with that. I want to actually bring something and deliver a product to the individuals and the borrowers and the consumers that actually will make a difference, and they will be able to afford the home that they want to live in instead of being press down and say, nope, sorry, you don't follow the standard, you know, ability to repay guidelines, and you need to live in a $600,000 house in an area that you don't like, and every single day that you go home you want to sell it, compared to, what if I put you into $1 million home because I know how much you can afford? They're going to stay there forever.
And, you know, and that is a great service to the community and also to the real estate community, especially because if you have someone, like if you're an agent, you're working with a buyer, and you think, hey, this person can really afford it. They can pay this, but they're getting turned down at the local bank. That's someone that you're an expert in figuring out how to get them financed on.
Absolutely. I mean, I love talking with those individuals and those consumers. I actually like, you know, piecing together. I have a really fun time trying to figure out loans. It was so interesting. I had a client, and I try to always answer my phone and never have anyone go to voicemail. That's just one of the things I always try to do. Like, hey, I will call you back after this meeting. Don't just go to my voicemail. And this borrower called, and he started asking a couple questions, and I was so, my brain just like clicked on to like, I got to figure this out while my client was sitting there. And after like a couple minutes, I was like, oh my gosh, can I call you back? Like, but I just love trying to figure out loans. And I love trying to figure out, like, and I understand the whole process of a tax return and how businesses and cash flow is really important. So having that understanding allows me to put the individual into the right financial position, just because it doesn't show on their tax returns and they're paying 50% tax on it. Yeah,
and that's in fact, I referred someone to you this week who is self-employed. You know, she's got her own business. That's kind of one of those businesses where there's a lot of expenses, low margins, but she does really well. She has a lot of assets. So it's like, hey, here's someone that's perfect for the Mortgage Geek. Like, he will figure this out.
Yeah.
If you can get a loan, he will figure out how to get it for you.
Absolutely. I just figured out another one. This borrower literally just got $2 million and it's in a CD. So all guidelines say you can't really use that unless you want to do asset depletion. We figured out that loan really quickly, and even though it's not into a retirement account and he's not retirement age, we just broke it up over 360 months, the $2 million, and said, here's the income. I know that you're good by using this amount of income for the next 360 months. So I'm not putting people into like a risky situation. I'm just allowing them to get into the home that they actually can afford.
Yeah, which is awesome, and there's so many things like this. So if you have, if you've been trying to buy a home and been turned down, or you think you can afford a payment, or if you're in the real estate business and you're working with a buyer like that, definitely connect them with the Mortgage Geek. As far as what's going on in the industry, we've seen rates come up a little bit. We have not seen yet, although we're starting to see a little price compression on housing prices as a result of that, which is bound to happen. It just is.
Absolutely. Yeah.
Not immediately, but it will start to happen as people are out there putting in offers and rates are higher, and they start going, man, we can't offer as much, on this place. Is there anything else you see happening in the marketplace that you think people should know about right now?
I mean, ultimately, I think that the rates are just going to continue to go up. So, am I trying to say buy right now? It doesn't mean that, but kind of have your eye, be a little bit more involved in the market, right? We're not in the 3s anymore. We haven't been. Some of the investments are actually in the 5s. These are actually decent interest rates. I mean, just on June 14th, they raised the prime rate again. Now that's at 5%, so, and it was at 3.25% for a long time. So just kind of be aware. Interest rates there's no indicators that are saying that the interest rates are going down,
right,
which can affect the, your payment. And it can, I mean, 0.25% on $450,000, just 0.25%, that's $70 a month. Doesn't sound like a lot, but break that up over 30 years, you're looking at $29,000 in just interest over 30 years. Not a huge fan of breaking something up over 30 years, but just wanted to kind of give you. You say, hey, 0.25% equals 30 grand. Whoa. Hey, maybe, maybe paying $5,000 more for this place right now, or settling out on, a couple of the repairs, if it's the right house, for $5,000 is kind of worth it.
A good deal.
Yeah, it is a good deal, because interest rates can increase even 0.5%, and they can move 0.5% before you even know it. And so I would just be a little careful. If you are in the market, maybe be a little bit more active in the market. Making sure you're working with the actual agent that hasn't put you on the back burner and put you into a drip and is like, well, when you go see a house, let me know, because a lot of deals are being done off market as well.
That's true. Yeah.
A lot.
We're actually going to talk about that quite a bit today at 2 o'clock with Melissa Sophia after the second edition of List It Live. It's sort of the back end of what's happening in the real estate marketplace. I know she's a big fan of the Mortgage Geek as well. So we have rising interest rates, price compression. We've seen a lot of mortgage banks like going out of business or shutting their retail doors, spinning off. Refis are pretty much gone. It's a purchase market. A lot of companies aren't positioned well for that.
No.
How do you see that affecting borrowers or loan officers in the business?
Well, I would be really careful with, making sure that your mortgage bank that you are with, or the branch that you're with, is actually financially stable. Because more and more, I mean, we're seeing mortgage banks, acquisitions, mergers, I mean, more this year than in the past, 5 years. I mean, everybody is saying, doing layoffs. I mean, I can find an underwriter and processor very easily right now, and these are really smart, intelligent individuals. It's just that there's just no volume there. So if you are just focused on 50 or 60% of your business being refinances, I mean, 50% of your layoffs might come from, just no volume being delivered there. And also what happens is, I've actually heard from other loan officers saying, well, because there's refinances, we're really starting to tighten up our guidelines. Okay, that is not true, no matter what. No one has tightened up their guidelines recently. The only guidelines that I've seen are actually getting a little bit looser. It's just that they're in a financial position where they don't want to take the risk anymore if it's not super cookie cutter. And they might follow one of their investors really strict overlays, and place all of them so that they guarantee the cleanest deals, because they don't want anything sitting on their line, or they don't want any loans that are costing them money on other fees.
They're going to become very risk averse.
Oh yeah, tremendously.
Yeah.
I mean, I'm in an escrow right now, and I just called the listing agent, and I was like, man, I thought that this my buyer who's buying and they were doing a sale, I thought this thing was supposed to close 90 days ago. And they're like, well, that person lost their job, and then they got a new job within 2 weeks. But, the current bank is waiting for 2 full pay stubs before we can close. And I was like, I wish you would have told me, because I would have closed off the offer letter. Oh, really? I didn't know that. I was like, yeah, you don't need pay stubs when you get a new job. I have an offer letter. I'm cool, even if the start date's after my close date.
Really?
So, yeah. And that was in one of my videos, too.
That's incredible.
So, guys, guidelines aren't actually tightening up. They're pretty loose right now.
And if you follow the guidelines, and that's one of the things, you follow the guidelines to a T, and a lot of places put additional layers on top of the guidelines.
Absolutely.
Which is why they'll tell you, no, the guideline says this, but it's not actually true. The guideline is much looser, the actual guideline.
Tremendously. I mean, I was at an organization there for a while and a little bit brainwashed in the terms of I thought that they were always just telling me the truth of what the actual bottom line guidelines were. And later on in my career, I realized, I was like, whoa, you mean that VA does allow 100% cash out? Because I was always told that was 90%. And everyone, you know, and I'm telling borrowers like, no way they can offer 100% the whole time. I was actually wrong. That was a long time ago, okay?
Before you became the president of your own bank.
Yeah.
Let's get to a question here from Brenda K. What's up, Brenda? She says, what is your opinion of selling now, renting and waiting out the crash and purchasing in a year or two? Good question. I'll just tell you, it's tough when you're waiting out the crash. I've been waiting out the crash a few years. I've been wrong. That stings. So like if you own, I think it's, my personal opinion is, you sell and buy in the same market. That way you're
100%.
always in.
Correct.
So if you're gonna downsize, like if we're in an up market, downsize makes sense. You know, upsize in a down market, downsize in an up market. That's sort of the rule of thumb. So depending upon whether you're upsizing or downsizing, it may make sense to wait. But if you are gonna downsize, I would sell immediately.
Yeah, absolutely. And there's nothing wrong. I mean, you could time the market wrong. I mean, we never know if there is actual crash going to happen. Just because it's like settling and where the prices are kind of coming down a little bit is more like the higher, like the $1.5 million and above.
Right.
I think that they have felt some.
They started to feel, so if you're moving down from like a 1 million plus home, definitely sell now, buy your $600,000 downsize home, do that immediately.
Yeah.
But if you're moving up, you can be a little more patient, but buy and sell in the same market. That's the only way you can make sure you're not going to mistime the market, is to buy and sell in the same market.
Absolutely. And you know, ultimately, like the contingent, if you do not want to use Cornerstone and use our bridge loan and recast option, which is like the coolest thing on the planet, we can talk more about that later, like call me. Selling your home and moving into a vacation rental, like fully furnished for like a month while you go and actively search, or 2 months, you guys, we're still in the same market. The markets cannot change. I mean, we live in $3.3 million, or I say 3.3 million population. It's not like 1 month is going to make a big, huge change, or 2 months or 3 months.
To the upside, for sure. A month or two could make a big change to the downside, which would be good for you if you had sold it. So there's no, but it's not going to catapult higher in a month or two.
No, it's not all of a sudden prices are going to be like $50,000. So, but I mean, so talk to your clients about that, or show them vacation rentals, or hey, I can maybe help you with my commission to put you into a fully furnished place for like a month. Check this out while we search, so that you're not contingent, so your offer's stronger. I mean, that would be some of my suggestions if you don't want to use my bridge loan recast option.
Brenda, great question. Thanks for participating. And Mortgage Geek, always great to see you, my man.
Cool. Thanks,
great
man.
stuff.
I appreciate being on. So
appreciate you, and I appreciate the Shiggy as well. Thanks for educating me on what all the young kids are talking about these days. Make sure you like the Mortgage Geek on Facebook. New video coming out today.